Hello, I'm Kimberly Romaine, Editor-in-Chief at Unquote, and I have with me here today Andrew Sealey, Managing Partner at Campbell Lutyens, a specialist private equity and infrastructure advisory firm. We're going to be speaking today about the recent developments and future activity for the secondaries market. Andrew, thank you very much for joining us.
Thank you.
There was a lot of expectation that 2009 would be a very high volume year for secondaries activity. Everybody was talking about the lack of liquidity with limited partners. But in fact, it's actually been a very low volume year. A lot of people have said that it's because there's been mismatch of pricing expectations on the vendors and sellers' parts. How do you expect 2010 to pan out?
I think things are starting to change now, and over the last 4 to 6 weeks we've seen buyers becoming more confident about the market and more aggressive in bidding. They've taken, I think they've assessing risk differently. There's probably less risk in the economy and the financial system. There's a little bit more visibility on underlying performance of companies, and maybe even the M&A market and IPO market are starting to come back. A new clearing price will be established, and hence volume will go up, probably towards maybe the very end of this year, or certainly in Q1 next year.
With these primary players more and more interested in the secondaries market, and especially the increase in fund of funds now looking at the space, how can some of the more traditional secondaries players continue to stay ahead?
Well, it'll be interesting to see if the primary players continue to play as the market recovers and prices increase. But if they do remain active participants in the market, the secondary market will have to exercise their competitive advantage, namely the the additional resource they've got, the technical expertise, and really apply this to doing larger portfolio transactions, to conducting structured transactions, and potentially doing direct venture and buyout secondary transactions.
So doing a lot less of the plain vanilla secondaries activity
and
taking
right,
it
yes.
to the next step. Okay.
That's right.
One of the major difficulties this year has been in the pricing of secondaries. I understand that not only are they being sold at discount, a lot of the sales that we have seen gone through, but some LPs are even offering to pay other investors to take these commitments off their hands. What has been your experience in the pricing that you've seen in the markets?
Well, there's been a huge variability, you're right there. And we've certainly over the last year sold assets from pretty close to NAV to, as you say, more than 100% discount. Wow. Where effectively the buyer receives consideration from the seller, somewhat unusual. I think this is most acute in the area of less drawn or immature funds, where maybe only 10 to 20% of the fund has been drawn down, and therefore it's more dependent on the quality of the manager and what buyers think will happen to the undrawn capital. So you can see a very wide range of pricing in those assets.
We've more recently seen some interest in direct secondaries. I think earlier this year we saw 3i sell a German venture portfolio to Scipio Partners. And most recently, we've seen them sell a much larger European portfolio to a consortium of DFJ, Collar Capital and HarbourVest. Why is there this increased risk in direct secondary synthetics? And who do you think is best placed to take advantage of this if we are going to keep seeing more of it?
I think there's always been significant interest in direct secondary transactions from the most sophisticated players in the market. Arguably, although there's less diversification, there is it's easier to do due diligence on the assets. One has much better access both to the underlying data but also to management teams, so one can better assess the opportunity. I think also there's the potential, because less players can participate in this type of transaction, there's less competition, therefore arguably one can achieve better returns. So it's driven, some people believe less risk, some people believe better returns, but it's certainly a smaller market.
It's interesting, most people that I've spoken to that are considering direct secondaries say that the due diligence process just takes a vast amount of extra time, and that would make sense based on what you're saying, but I don't think people necessarily correlate that yet to the fact that it is ultimately a lower risk activity.
Yeah.
That's an interesting
But
way
it
to
is
look
very
at it.
complicated, and we were advising on the recent 3i transaction. There were 35 venture investments in 7 jurisdictions,
Wow.
and it takes a lot of time. This is not for the faint-hearted.
What is a lot of time? When did you start this
We
process?
started the mandate in February, and it completed in September, which is not unusual time frame, and this is probably one of the more complicated or most complicated transactions completed in the secondary market over the last couple of years.
And how does that compare to if you're doing a more traditional secondary, so not of
Well,
the
a
direct?
portfolio of fund transactions, a portfolio of funds that is being sold, there may be 400 or 500 underlying companies, and one can't possibly do that level of due diligence, so one's taking a more top-down view than bottom-up view.
Okay, but in terms of if that took 7 months, how long would it take if you were just doing a more traditional secondaries?
It could take anything from 2 to 4 months.
Okay, so substantially shorter time period. Finally, people are talking about banks as being one of the most likely sellers of their private equity assets this year and next, and that's not surprising given a lot of the difficulties they've been facing. But on top of that, people are talking about the market recovering. Do you think we'll start to see other sellers of private equity in 2010?
Yeah, I think you're absolutely right on the banks, and although they have already sold some assets, I think they're likely to sell significantly more private equity assets. We expect over the coming months, and certainly over the next 6 to 12 months, the banks to be probably the major sellers of private equity assets. In addition to that, we may see the insurance companies, maybe under a little bit of pressure from under Solvency II, become sellers. We're already seeing some of the endowments, some of which tried to sell last year, coming back, and there's one big endowment selling $1 billion portfolio at the moment. So I think it's going to be across the board. And again, as you said, as prices increase, so some of those reluctant sellers will come back to the market, and we expect to see volume increase very substantially.
It'll be interesting to see if a lot of them start pursuing, from a buying point of view, if LPs start pursuing secondaries activities at the expense of primaries, but I suppose we won't know that until next year. Thank you very much for taking the time to speak with us. This is Andrew Sealey of Campbell Lutyens. I'm Kimberly Romaine of Unquote. Thank you for watching.